to the last day of our sustainability conference. We've had a very exciting trip through sustainability so far. We started on Tuesday with Will Wynn, who talked about implementing sustainable cities on a grand scale and a view from the US, which was really, really interesting. And then in the afternoon, Sarah Miller took us through what it's like to do it at a local level and do the community project aspect, which was really actually even more interesting in some respects, because it was how did they transform a community, and it was real, very tangible. Yesterday, Jeffrey Graham had a really interesting interview with Barry Andrews, who was able to talk about the sustainability at a European level. And then we followed up with Minister of State Robert Ireland on financial services, insurance and credit unions with what they're doing at a local level in Ireland. This morning, because we're coming back to our members at the end of the day, at the last part of our conference, I'm delighted to welcome our member, Michael Naylor, to share his knowledge about private equity investing. This is obviously an area that is of interest to nearly anybody who runs a business, but at the same time, most people are very unaware of what's going on in the world of private equity, and Michael is here to share his knowledge. Thank you, Michael. I'm really pleased to welcome you this morning.
Aoife, it's an absolute pleasure to be here, and congratulations on what has been a great conference. I've had the opportunity to tune in and listen to your speakers. They've done a great job, so I'm looking forward to engaging in the conversation this morning. But you're looking very well, Aoife. To say it was St. Patrick's Day yesterday, you're looking remarkably well. Oh,
I've done that. Rode that horse. I've gone through the St. Patrick's Day, and never again, Michael, never again. we let him run off into the sunset. But anyway, Michael, most people are not familiar with you. They haven't seen you at network events or anything too much. So this is your introduction to the Ipbn. Could you tell us a little bit about yourself, and particularly your Irish connections?
Yes, well, Aoife, I think probably the people who are tuned in know that I have a family office. I'm investing in the venture capital and the private equity and the funds world. That's where I am today in my investing life. I'm not Irish. You can tell that I'm clearly from out of town. I'm actually from South Yorkshire, from a fairly hard mining village just outside Sheffield. But thank goodness, in 1995, I met a beautiful Irish girl from Wicklow town, and spent many happy days in Devil's Glen and the Wicklow Mountains. And so my Irish connections are absolutely through Vanessa. But from that, over the years, I've done quite a lot of business in Ireland. And early on in my career, I'm pleased to say I met a range of, by chance really, a range of Irish entrepreneurs who've stayed my close friends and been on an investing journey with me for 25 years. So Ireland has been quite an important part of my life and part of an important component of my investment portfolio. And
Michael, you have a very interesting backstory about your green ethos and how you developed an interest in green venture and equity investing in green ventures, should I say. Could you tell us a little bit about that?
Yeah, well, Aoife, I think that goes back to to my roots in South Yorkshire. I was brought up in a fairly hard mining town. In our area, we had a family business in textiles, and where I was brought up, you either worked for the National Coal Board or you worked for the business that my family was associated with. And in my lifetime, which was obviously before Britain entered the European Economic Union, I remember pit heads being fully operational, spinning wheels of pit heads. And until I was 10 years old, in fact, when Britain entered the EEC, as it was called then, and regulations stopped these very high levels of pollution, I used to go to sleep every night seeing the sort of flicker of the gas flare from the coking plant, which was about 5 miles away from where I lived. So that would be impossible to think of today, that you'd have such, frankly, horrendous levels of pollution in the air as I was brought up with. And so I think there was also something else that came out of that in my thesis, which was I always asked the question, you had open cast coal mining going on in my area. And I always said, what happens when it runs out? And the answer was always the same. Oh, there's so much coal under the ground here in South Yorkshire. it'll never run out. And of course, in my lifetime, it did run out. The pits closed, and I lived through the miners' strike. I was 20 years old during the miners' strike of 1984. And we went into that year with, I think, something like 240 operational pits, mines in the UK. And by 2015, there were none. So when people talk about sustainability and working within limits of finite resources, I think probably my early years had a profound effect on me as I started to question many of those unanswered questions that people were struggling with 10 years ago. But I'm pleased to say science has now got us the right side of.
So when you, so this formed your ethos about green investing, but where did you start?
Well, I didn't start in renewables. You know, I was listening to Barry yesterday, and I was smiling that he was a member of Greenpeace and the Dublin Green Cycling Gang. I never came at this as a climate activist, actually. But I did live in Texas, so I had that in common with Will. I moved with Vanessa to live in Texas in the late 1990s, and I'd wanted to go to America, and I started working with a remarkable entrepreneur called William Kriegel, who'd arrived in America with $10,000 in 1982 and started an independent private power company called CISI Energies. And I started working for William, and it was absolutely not renewables. We even owned, I have to admit, some coal plant, but it was predominantly gas and power. And it was driven by regulation. There was this, while Will was running the regulated utility in Austin, William was building an unregulated independent private power company. And regulation had made that possible. And William grew this business very, very rapidly through the 80s and 90s. I started working for him in 1994. And I became involved in the development of independent private power assets. In December 1999, William's original $10,000 had turned into a significant business, and he sold that company for $5.5 billion. So it was a great exit for him. He became a very wealthy man. He was 55 years old at the time, a little younger than I am now. And I'd always been pushing him to invest in renewables. It was very early days. You know, there were still blades flying off wind turbines, and it was not a sure thing as it is now. And after William sold CISI, he asked me to stay on with him. And then I convinced him to make his first investment into renewable energy, which is where my renewable energy investing sort of story began. And William is still my business partner today.
Great. Would you like to take us through some of those early businesses that you had and what you learned along the way? You know, how you started the investment and the successes and failures.
Yeah. So if you go back to the early 2000s, investing in renewable energy, it was very early days, and there were a few entrepreneurs who saw the opportunity, who cared passionately, and were early movers in the whole question of the climate debate. And William and I did develop out one of the largest solar power projects in the US. Again, Will had his 30 megawatts in Austin, but we actually developed 330 megawatts in northern Nevada with a First Nation tribal people, the Moapa tribe, just outside Las Vegas, which was one of the largest solar development projects in the world, actually, at the time. So we used a lot of the skills that we had from developing large gas and power projects and bringing that to the world of renewables quite early. At the same time, there were other entrepreneurs out there. They were mainly families. The McAlpine family in the UK were very early with a company called Renewable Energy Systems. Lord McAlpine loved two things in the world. He loved helicopters and he loved pouring cement. So with wind turbines, he had the spinning blade and he could tip lots of cement into the hole. That grew into a multi-billion-pound business. And indeed, Tom Roche, one of my good friends there with NTR in Ireland, backed a kind of slightly eccentric entrepreneur called Eddie O'Connor, and put a few punt behind him in those days to create a company called Airtricity, which by the time, fast forward, when wind renewables had become more mainstream, that was a €2 billion exit for Tom, and set Eddie O'Connor up for his future business ventures in a company called Mainstream. So we were quite early, and this was still difficult. It was still risky. Solar was very expensive, but we had a very clear view that the cost of solar would be brought down very quickly by the Chinese. And there were lots of technologies floating around. Some people were looking at wave power. There were many things in the mix, but William and I felt at the end of the day that if you could reduce the cost of a semiconductor as quickly as it did from the 1980s to the 2000s, the Chinese could probably do it with solar panels. And we were right about that. So we picked the right technology, and it was a very good investment for us. Of course, that's now become much easier. And because it's become easier, the returns have become compressed. And today, investing in wind or investing in solar is predominantly a core plus infrastructure return. It doesn't generate the type of returns that the early investors were able to take. But today, there are still tough businesses to decarbonize. So what was difficult going back to 2000 or 2010 is pretty straightforward now. What is difficult today is where we're becoming very interested in making investments. And these are tough to decarbonize sectors, and that would include textiles, it would include the aviation sector, and it would include industries like cement. So we think there's a whole new generation of tough challenges to take on, where there are great returns to be made for those who are willing to take the risk.
And did you keep all of your investing strictly in energy, or have you diversified out of that a little bit?
So, Aoife, I think in around 2000, 2002, I made a commitment that I was going to be all in, and the portfolio that I wanted to build in our family office would be entirely focused on the sustainable asset class. And so it began perhaps with, this journey begins with an ethical screen. You then look at the ESG integration aspects. There's then sustainability themed, and perhaps on the far right-hand corner of the bookend would be impact investing. We were very clear that we had ethical exclusion. That was always the case. ESG integration was just a given. And then in 2002, we said we would absolutely focus and build a portfolio only around sustainability themed investments. And aside from one investment over the last 20 years, I've stuck to that and been honest to that commitment.
So of those ones, we'll get to your current investing and the current market in a couple of minutes. And just as I'm talking to you, and I just remind people that if you have questions for Michael, please put them on the chat and we'll pause in a couple of minutes to answer them. So of those, what were the successes, Michael, the ones that those impact investments, what have you seen emerge from that?
Yes, so Aoife, just to qualify that, I've not been a significant impact investor, I have to tell you. So of those four themes, from ethical to ESG to sustainability to impact, I've been totally committed to the first three, but I've been less involved in impact, because impact is around targeted investments aimed at really solving a social or environmental problem. And that's really targeted at an underserved community. And in our commitment to that, through our family office, that has been more through philanthropy and creating prizes and charitable giving than actually impact investing. So I do just want to qualify the difference, because people tend to be interested. What is the difference between ESG and sustainability? And what's the difference between sustainability and impact? So there is a nuance there. Mm-hmm. But your question was what worked? What worked? Well, we were able to. We developed 330 megawatts in the deserts of Nevada with the First Nation tribal people Moapa, and we sold that to First Solar in around 2010. That was a $1 billion exit for William and myself, and then we went on. And we were early movers in battery technology. So we had a company in Santa Clara, California, called Green Charge Networks. So we were involved in using batteries for energy management. We sold that company to Engie of France. That was a pretty good exit for us. After that, we got involved in waste to value, the circular economy. And we were involved in a business that was involved in wood pelletization. We were able to sell that, so that was a pretty good exit. So quite a lot, quite a lot went right in that period. But I was working with a man who had great pedigree as an entrepreneur, so it certainly wasn't all me. But I was on the coattails, and William and I were working together, and clearly committed to this asset class. Yeah.
Mm-hmm. And when we were preparing for this, I said that you should probably also mention anything that you've learned from something that maybe wasn't as successful, if not quite a failure along the way. Do you want to take us through that one?
Yeah, so I think there are many reasons why investments don't work out, and there are books and Harvard case studies on this sort of thing. But for me, I think that the two, we've made 20 investments over the last sort of 12 years. We've had 8 successful exits. That's well documented. But I think 2 things didn't work out as planned. When we were making the commitment to the solar early days of solar investing, it was quite open. We weren't sure what was going to win. And I found myself coming down to Portugal, standing on Guincho Beach and just looking at the energy in those waves. I think it was sort of October time, and there was these enormous waves coming into Guincho. And I thought, goodness me, just look at that. Just look at that energy. If we can harness the energy of the wind, we must be able to harness the energy of the waves. So I convinced some investors to join me on a journey. My business partner in America, William Kriegel, said, no way, that won't work. Actually, he was kind of right. But I said, no, this could be it. And it absolutely wasn't. There was a big difference between backing solar technology, which the Chinese were ramping, and trying to put large pieces of steel in the sea off Orkney. And so the problem with wave power is you could never reduce the cost quick enough. So it always became an expensive power option. And if it's expensive and it needs subsidy, you can't scale it as you need to. And obviously, we've now seen wind and solar as a form of renewable energy that really doesn't need any subsidy at all. So these technologies that are on the boundary didn't make it. And our investment in Wave ended up as a little niche play where this technology sits in harbor walls of small island nations like the Azores, where I'm sitting now, or Tenerife or Palma. So it wasn't a disaster, but it didn't produce great results. And I think the other that didn't work out is where, and it perhaps is a lesson in investing, is where we made an investment alongside an American venture capital fund without perhaps realizing how American VCs worked, which is very different to how a family office works. We talk about patient capital. One of the early investments we made was in an information provider called New Energy Finance. We were very keen that information around the new energy economy could be easily accessed. So we backed an entrepreneur. That business got bought by Bloomberg 5 years after we invested, and it was a very, very good investment for us. It was sort of double-digit multiples on our invested capital. But there was, along that journey, there was a point in time when the chief executive said, the contract hasn't come in, the conference has gone wrong, we're out of money. And we stayed up late that night, the families came together and we said, we're going to back Michael through this. And on Monday morning, the company that would have been insolvent wasn't insolvent because we stood behind it. And at the end of the day, that became a very valuable company, and it's known as Bloomberg New Energy Finance today. In the case of the business that went wrong, the American VCs just said, we're out. You know, we have a portfolio of 50 investments. We think 5 will make it, 45 will lose. We're gone. And we said, well, you know, hold on a minute. Maybe we just need to. And they said, no, we're out. And that, you know, that was a shame. The company had to be sold very cheaply. We didn't get all our equity capital back. It was sold to a larger energy services group, and today is a very, very profitable and successful division of that company. So, you know, those were two important lessons that we learned along the way, that you can't always get it right, but hindsight is a precise science, as we know.
So, yeah, that's true. And, you know, now you're involved in something that many of us don't know much about, which is investing in a market that seems to have unlimited investment money available, but it's also very difficult for smaller business to get their hands on it. So you tell us a little bit about what the current private equity investment platform is at the moment in the world and what you see happening in it.
Well, Aoife, the world is basically awash with cash, right? I mean, there is unbelievable liquidity in the markets today, and particularly for private equity investing. And there are some reasons for that. And some of the reasons that are driving this depth to the investing market, some of them are new. So the first is we have interest rates, inflation and interest rates at record low levels. I think, you know, I think the number is close to what inflation was in 1871. You know, and that means that people are looking for places to put their money, and it's not in a deposit account of a bank anymore, where they're, you know, in Europe receiving nothing or even negative interest rates. But even the 10-year US Treasury bond, you know, is 0.7. So people are just looking for other places to put their money, and so that is one reason that all that liquidity has kind of freed up. Funnily enough, COVID has increased liquidity because people are just simply not spending money because they're saving money, they're putting money into the market, which is driving increased retail demand. And I think the other reason is that there is a strong sense of FOMO. I mean, people have seen what Elon Musk did with Tesla. They've seen those types of returns, and they're asking themselves, I miss that. Or if they caught it, you know, they've done very well. They want to do some more. If they missed it, they don't want to miss out. So where is the next innovation coming from? Where can I now invest in innovation? Historically, people might have put money in the bank and then invested in stock markets behind very established players. But they've seen that the established players somehow get left behind. And now they want to participate in that innovation and that growth. And then, of course, there are new models emerging. There's this phenomenon of the SPAC market, which has re-emerged as sort of SPAC 2.0 in America, which is creating enormous liquidity in the investment market and giving big ticket private equity a run for its money, actually.
So could you take us through the SPAC idea first? Because I know that, when we first started talking 6 weeks ago, I had never heard of it. And then next minute I see it's all over the pages of the financial press. And you actually have a personal interest in one. So if you could just tell us what exactly a SPAC does and what its particular advantages are, and the things that we have to always keep in mind that there are sometimes disadvantages to these things as well, Michael. So
yeah, sure. So look, if I'll sort of take this on, right? But I don't want to turn this into a SPAC masterclass. So I'm going to try and give you the 2-minute version.
Please.
But SPAC stands for Special Purpose Acquisition Company. Our European members will know it as a good old-fashioned cash shell, a reverse takeover, or in America, a blank check company. And they've been around for a long time. They were always seen as a little bit subprime. I mean, for people who found it difficult to raise money, they would find a listed vehicle with a few $1 million in it, or a few £1 million, and they'd reverse into it and it'd give them some cash. And grown-up people did old-fashioned IPOs and did it the proper way. That all changed with the with the entrepreneur Chamath Palihapitiya, who was one of the founders, of Uber. And he just saw the opportunity that was presented in today's market. And I go back to low interest rates, Elon Musk, Tesla, FOMO. And he said, goodness me, there are far less listed companies in America today than there were 20 years ago. And it's quite true. So people see that these SPACs, these cash shells have been launched on NASDAQ and on NYSE and now in Amsterdam and Paris. And they say, goodness me, there's 400 of these things. Is this too much? But I remember the first time I bought a share in America, it was 1996. And I phoned up my broker and I said, can I buy some Microsoft shares? And there was quite a palaver to fill in paperwork and tax forms and these things. And a week later, I could buy shares on the New York Stock Exchange. Today, our son and daughter can buy shares at the click of a button on their Revolut phone. In under a second, they can buy and sell Microsoft shares. But in those days, it was more difficult. And I said to my broker at the time, that's interesting. I bought my first share in America. How many quoted companies are there on New York Stock Exchanges? And there was 7,200. I mean, I remember the number. Today, there are less than 3,500. So, we've lost thousands of quoted companies. And there's a reason for that. They've been bought up predominantly by private equity, or they've been delisted because the market hasn't been valuing them properly. And Chamath realized this, and he said, look, people don't want established players. They want innovation and they want growth. And we need to, and we don't have it on the stock markets in the numbers that we need. People want to find these innovative growth companies, and we've just got very steady state businesses. So he created sort of SPAC 2.0 as a way of raising money to then find these innovative companies which are privately held, merge with them, and then through that process list them on the stock exchanges in New York. That's essentially what a SPAC does. And I got involved because I have a technology company that I own in India, which is kind of disrupting the Indian tuk-tuk market with a battery swap model. And we were approached to merge with a SPAC, and I'm deep in that process. But I learned enough about it to then launch my own SPAC, which I have now done. So I filed an S1, and I'm launching my own SPAC around the climate theme, around energy efficiency, actually. And we'll be looking to put that on the market at the end of April or early May.
And
but just to give you some idea, Aoife,
yes,
there's $101 billion in trust in New York. There's been 264 SPACs raised already this year, $80 billion, which is more than the entire number of SPACs that were raised in 2020. And if you look at the multiple of what that 100 billion in trust can now go out and buy, it's a multiple of about 6 to 7 times. So to put that in perspective, there's about $700 billion of acquisition capital sitting ready to go in New York this afternoon, which has to be deployed in the next 24 months. Because when you launch a SPAC, you have to find a transaction within 24 months or you're timed out.
And you hand the money back. Well,
the promoters like me, they don't get their money back, right? And there's a lot of talk about SPACs that we're sort of pirate buccaneers and it's the South Sea bubble all over again. But my dollars that I've put in to form the SPAC, and it's not cheap to launch a SPAC. It's about $10 million to launch a SPAC in New York today. All that money is at risk. For the investors who come into the IPO of the SPAC itself, the money goes into trust. So they actually can't lose their money. Because if I don't find a transaction, and my team doesn't find a transaction, we fail, we lose our money, but they get all their money back. Yeah. And of course, as well as when you do a SPAC, the interesting feature of a SPAC as an investor is when you invest, there's a split and you get a share, but you also get warrants. So you can invest at the IPO and you can sell your shares, but you're left with the warrant. So for the hedge funds, this was very, 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 very interesting, because, they have the money on deposit on a 10-year treasury at 0.7 interest. They can put it into a SPAC and they're not going to lose their capital. And that's one of the things that Chamath realized and what drove the SPAC market. And then, of course, when you've launched your SPAC, you find your target, you combine, and then you list. And at that point, the retail investor can participate. So in the SPAC market, you're either a promoter, which is what I would call venture capital. You've got real money at risk, or you're an investor in the SPAC IPO, and those tickets tend to be quite large. Yeah, so they're really the preserve of hedge funds, institutional investors, or large family offices. You can't buy $100,000 of a SPAC IPO. It's a much more significant commitment of capital, but the family offices are participating there. And then when you've gone through the process and you do actually merge and then list, then it's open to the retail market, and you can buy $10 of shares if you want. So that's sort of how it works. Mm-hmm. Took me more than 2 minutes. Sorry, Aoife, but I hope that's helpful.
I don't think we're too stuck for time anyway. So I was going to say, what sort of companies would be suitable for SPAC listing? I mean, most of our members would not be looking at it, Michael, but just out of interest, what sort of companies are suitable for it?
Yeah, so I think for us to have a successful SPAC, you've got to find a growth company. So you've got to find a private company that's a good company. It's a company that is in a sector that is positioned for growth, and it's a company that is capital markets ready, essentially. And the nuance of the SPAC market is you don't have to have 10 years of report and accounts. You do have to have 3. And you've really got to be ready to be a capital markets. You've really got to be ready to be a capital markets company. But what attracts SPAC investors are companies that are positioned for growth. So any established player that's trading on a multiple of 8 times is not a SPAC candidate. It just doesn't. It's not going to be the next Tesla. It's just not interesting enough for the market. So what we're seeing in the SPAC space, we're seeing, a lot of tech emerge, and certainly sustainability is a very strong theme, particularly electric vehicles, because they just, people recognize the growth, regulation, meaning that diesel and petrol cars have been phased out. These types of businesses have large new total addressable markets, and this is where you're going in what I would call SPAC land. I look at investing in much the same way. I think you have real innovators, you have innovator accelerators, and then you have established players. And you choose as an investor where you want to be. If you want to be safe as houses, widows and orphans, you're going to invest in very established players, and you're going to get a steady state of growth and dividend income. At the other side, if you want to take more risk, then there's the opportunity to really participate in innovation, support those innovative ideas, and take them into the innovation growth phase. And at that point, they become very interesting to the SPAC market. Because what the SPAC is, when you back as a venture capital investor, you do a pre-seed round, you do a seed round, you go into an accelerator round. And as you become more grown up, you do a series A, B, C, D, and then you either sell to a strategic or you list on a stock exchange. What the SPAC enables you to do is when you get to the series A type of time frame, you can just do it's effectively a series D done early. So the SPAC gives you quite a lot of money very early on. And if you've got the management team that's capable of deploying that capital into growth, you then turbocharge, you blitz scale your growth by taking the money early. And it would be difficult to do that through traditional private equity, right? You have to go through the A, B, C, D funding rounds, yeah? And that takes years, it takes 4 or 5 years. Whereas in the SPAC game, you can get there very quickly. So it's very tempting as shareholders or chairman, CEO, and the board of a growth company to really consider the SPAC route. Yeah, but it's all about growth. It's all about growth.
And Michael, just before we leave that aspect of investing, I just wanted to check with you about Tesla. You've mentioned it a couple of times, and when we were preparing for this, we checked out, it was like 1.35 million euro worth of stock market value for every car that comes off the production line. Is there an investment bubble in certain parts of the market at the moment?
So, Aoife, I have to hold my hand up. Back in sort of 2010, William and I had the opportunity to invest in Tesla pre-IPO. I mean, before Elon listed the company. We were identified as an investment platform that was committed to the sustainability investing space. So we were invited by the bank that actually then led the IPO in this pre-IPO round to invest in Tesla. Oh my goodness me, we didn't make that investment, right? It just looked very expensive. Yeah? It just looked very expensive. How wrong we were, right? And so I think Tesla has looked expensive for over a decade. And to me, it still continues to look very expensive. The mistake I made is that in technology and innovation and growth and acceleration, you have to back the entrepreneur. Sometimes you've just got to back the man or the woman at the helm of that business. And I think, when you invest in Tesla, you invest in Elon Musk, and then you become made aware of other opportunities because you're with the man. And so where you come out in the investment return is still an unknown, because goodness knows what Elon's going to do next. But he is a force of nature, and you can't write him off. So I'm not going to express opinion whether you should buy or not buy Tesla, but I don't hold it. It looks very expensive to me. But we're late. We're late. If you were early, it was great. But I do think watching a man like Elon Musk is important, because he is a true innovator, accelerator, entrepreneur of our time.
Mm-hmm. And that sort of brings me to the idea, particularly as there's probably some startups on the call, Michael, of what you look for in a management team when you're investing.
Yeah, so Aoife, it's a big question, right? So, I mean, obviously, the 30,000 feet answer is we look for passion and commitment. Yeah, that's very, very important. William and I put the entrepreneur and the management team before anything else. I mean, it's the first thing we look at before we address the total addressable market of the business opportunity. Before we hand it over to our financial analyst to look at the proposition, we need to get comfortable with the entrepreneur. And I was very lucky in my journey in getting to know Ireland that I met some remarkable entrepreneurs. I met people like Tommy Breen at DCC, who today DCC as a company is what I would call an established player. But I knew Tommy when it was still listed in Ireland before it went to the FTSE 250. And if anybody looks at the 5-year chart of DCC, what a fantastic investment that was, and what a remarkable chief executive and entrepreneur Tommy Breen was. Development Capital Corporation of Ireland going back. Elon Musk type returns. Let's not deny it. That was done by Tommy Breen. So I met people like Tommy. I obviously met and worked for Tom Roche at NTR when, and he backed a man, he backed Jim Barry. He was a very young CEO at his time. Tom hired him out of Morgan Stanley. And he took the reins of NTR as the chief executive, in his mid-30s, quite young. I mean, today Jim Barry is the global head of real assets at BlackRock and reports directly to Larry Fink. He's probably number 6 worldwide in the BlackRock organization. And that, that is my point. The talent was there. And I had the great pleasure of working with Jim. And in fact, we were on the phone together last night. He's doing very well at BlackRock. He certainly did very well for Tom Roche. And then, of course, I met, along the way, you meet. I know this has been recorded, so I could put this, just out there. But you occasionally meet pirates. So I did meet the Irish entrepreneur Norman Crowley. And he was, of course, Ernst & Young Irish Entrepreneur of the Year at one point. But Norman, had a kind of road to Damascus conversion on climate and climate investing. And, he's a heck of a character. And I have to admit, I've agreed to join Norman's board at Cool Planet. So it does, if you're a little bit eccentric, you're a little bit out there, it doesn't preclude you from passing the test, the high bar that we put up in terms of management. So management is the key, Aoife. It always has been, and it always will be. Yeah.
Mm-hmm. I'm going to pause for a moment, Michael, to get you to catch your breath. And I'm going to check with Arnold. Is there any questions in the chat that we need to have a look at?
Yeah, actually, there was a question regarding the management, the leadership team. But Sharon was asking that, the difference between the startups and then the next phase. And there seems to be lots of support for the startup company. But what happened after the scale-up phase seems to have less support. She wanted to have your opinion on that. And then you have Gerard. He's got some investment opportunities for his partners, apparently. He wants to talk to you.
No problem. Yeah, so look, what we call the pre-seed round is often dominated by what they call the 3 Fs, friends, family, and fools. So a lot of the early tech entrepreneurs do get their initial capital from friends or family. Our son, James, is 22 years old. He's the co-founder and CEO of a tech startup in London today. I didn't invest in my son's startup. I didn't think it was right that I did. I think Vanessa put in £500 or something, and he twisted his grandmother's arm for a bit. But he essentially went out and he found through the friends and family enough money to bootstrap a startup business. And then he was able to take that to a seed round, and then he got backed by Brent Hoberman at Founders Factory in London for his accelerator round. And he's probably 6 months away from a Series A. So we're very proud of him. So we've sort of lived through that story. I think the important thing is, friends and family aside, that when you go into a seed round, you really want to be taking money from investors who can see you through into the accelerator phase. And if they can't see you through from their own checkbooks, they should be well enough connected to people who can. I think it's a great shame when entrepreneurs start a business and they raise some money at seed and everything is going very well. And those early investors have maybe put in, 50,000 euros or 100,000 euros, and they've raised maybe a total funding of 300, and the company's on a trajectory. But at the seed round, they need 1 million. And they go back to those early investors and they say, well, actually, I'm kind of tapped out. And then you start running out of money, and then it becomes quite difficult. So the strategy around fundraising is at seed, try to think, don't get too excited and take early money. Try to find money that is really engaged, that's value added to your startup, and who has the capability to certainly get you through the next round or into a convertible loan note without saying, actually, we don't have any, we don't have the liquidity to take you through the next stage, because that's always a shame. And obviously we see quite a bit of that, but it's difficult to fund the next round of a business that's running on fumes, because a good chief executive, chairman, and board really shouldn't put a company in that position. They should have thought that through better. Yeah.
Harsh but true.
Harsh but true.
Mm-hmm. So, Michael, we're coming into the last few minutes now, and what I want to look at is the future. Okay. How urgent do you think the need to decarbonize is and to monitor climate risk in business investing?
Aoife, I think we have the fierce urgency of now. This debate is over. Science has won the day. I was very fortunate quite early on in the late 1990s. I met a remarkable man called Professor Sir John Horton, who became my mentor on the whole topic of climate crisis. So I was an early believer. I wasn't like Barry in Greenpeace, but I was listening to the science. And Sir John opened my eyes to that. He was a Nobel laureate. He won the Nobel Prize in 2007. And he made me very aware that this is for real. You know, there's a lovely story, Ethan. Our daughter Lucia, when she was in, I think, 4th grade, she was 10 years old. She decided, she was asked by her geography teacher at her prep school, who was married to a man who happened to work for Shell Oil. And so in those days, you even had geography teachers in schools who were climate skeptics. I mean, it's a horrible thought that you know, your children could be educated by somebody who hadn't listened to science. But her husband worked for Shell Oil. He was in the oil trading group. And so Lucia decided that her school presentation was going to be on climate change. And so Lucia borrowed the apple and she did this presentation. And Lucia, who was not a precocious child, never has been, was there when we had Sir John Horton round for lunch on Sunday. So I saw this going on, and I saw Sir John helping Lucia, and I went along to have a look. And Lucia said, "Sorry, Daddy, do you mind?" So this presentation was on, and that evening I said to Lucia, "Look, can I see what you're going to show your classmates tomorrow?" So yes. And the first slide came up with these big letters, CO2. CO2. Next slide is a heat trapping gas. That is a scientific fact. And I said, you know, Lucia, that's pretty good. That is true. There is no debate. And there's never been a debate on that. All the climate skeptics, people like Lawson, who were making money giving lectures in the city, that climate change was a hoax. He never accepted to debate. I mean, Sir John offered to debate Lawson on many, many occasions. Nigel Lawson never took that on. He never accepted that challenge because he knew he would lose. It was ridiculous. Anyway, Lucia gave this presentation, and the geography teacher was in very, very quickly. And CO2 is a heat trapping gas. And excuse me, Lucia. You know, there's a lot of debate around the validity of climate change. Where did you get that fact from? And Lucia said, well, Daddy's got a friend, and he's called Professor Horton, and he's a professor at Oxford University. And I was talking to him about this, and he said, and the teacher said, well, what would, and he won the Nobel Prize. And the teacher said, oh, so what would Professor Horton say if I said there's a lot of debate about that question? And Lucia said, well, he said, if anybody asks that question and they can prove him wrong, they can have a Nobel Prize too. So I think science has won the day. There's now no debate. We need to decarbonize this economy. We are running out of time, and we need to move very, very quickly now. And it's presenting a great opportunity. This is, you know, many of these businesses are now no longer subsidized. And as an investor, you can choose where you want to play. Hard to decarbonize areas, textiles. You've got great companies like Renewable, who can now recycle a pair of jeans 7 times with the same denim quality. Companies like Hoffman Green Cement, producing cement at 1/5 of the CO2 of a traditional cement producer. You can go to innovation, you can be in acceleration, you can be in established players. If you want to buy a wind farm and have a 5% yield, you can buy that. Contracted revenues, you can now choose. But my advice is everybody should build the sustainable asset class into their portfolio somewhere. And I have to say, I'm very proud of my father-in-law and my mother-in-law. My father-in-law is 89 years old, My mother-in-law is 79. They sold their holding in their oil companies last week to make a private equity investment in a climate artificial intelligence machine learning company. They really did it. So they're sort of saying, we believe in it, we believe in the future, and we want that to be our legacy to our grandchildren, that we actually put an investment into climate tech. So more people need to look at it, be active in it. There's an enormous investing universe, but we are running out of time. And I think I would just say one other thing. Post-COVID, economic recovery is a great opportunity for this asset class. This is not 2009. In the old days, policy was pushing the solution. Now the solution is pushing the policy. And I think we really heard that from Barry yesterday. We're starting to be in a very, very good place. So I think this is a good time to be confident and to invest in sustainability or even impact. I'm starting to go, looking at impact as well. So.
And just to finish out this section, Michael, is there enough will and money to do this, to make a difference?
There's certainly enough money in the world, Aoife. Yes, there is certainly enough money in the world. We can make this happen. The will, I think we all have a responsibility to our children. They will work it out, but we have to make sure that we hand over. There was the famous quote from Margaret Thatcher: "We don't own this planet, we merely have it on a full repairing and insuring lease." And nothing could be more true. So when we hand over that lease to our children, we've got to leave this planet in a way that gives them a chance. COVID has shown us what happens. It runs away from you, and it's very, very catastrophic. The COVID wave is like this. The climate change is bigger. We have to control this now. But biodiversity collapse is a tsunami. And biodiversity collapse can be triggered by some of these really worrying climate issues, climate indicators that we're seeing now. So we have been warned. Science, it's not debatable. We know the risks. So now there has to be a passion to move it. And yes, look at everybody's individual portfolio. Mine is about 98% committed to the sector, and my returns are pretty good. So I'm a good case study that you can commit to sustainability and make great returns. But one really needs to think about their portfolio, their parents' portfolio. We need to mobilize more capital to get there quicker, because we are running out of time.
Mm-hmm. We're coming to the end, Michael, and I'm going to ask everybody to send in a few more questions. But my last question for you is, you've set up your life in Portugal. How did that come about? And also, could you tell us a little bit about a project that's very close to your heart with the NHR Compassion? That would be great too.
Yeah, so look, Aoife, early on in my journey, I was involved. I was sent down to Portugal, and I worked for the London Merchant Bank, SG Warburg. They had an outpost here in Portugal. So I was here before Portugal went into the EU. I was here in 1991. That was the year before Portugal's ascension to the EU. So everything was getting prepared for privatizations. And I was sent down as a young banker, and I really loved my time here, and I made many friends. And some of those people that I worked with all those years ago became really quite important, much more important than me. They became sort of chief executives of quite significant, we were all young analysts together, but they became chief executives of quite important Portuguese companies. So we were on that journey together, and we kept in close contact. So I always loved Portugal. I came here for the first time with my father. We were in the textile business in Yorkshire. I came to Portugal in 1973 on the QE2 with my father, sailing from Southampton to meet some of his business partners here. They came down from Porto. We docked in Lisbon. I remember it very well. It's all in the family photograph albums. Then I was back in 1991. And so I had very happy memories here. And it came to a point, particularly Brexit, you know, I was not very happy about that. And there was just an opportunity in our lives that I could swim up my old river back to Lisbon and bring the family as an NHR. So that's exactly what we did. We have 4 children. James is in London. Lucia is 20, is at University Nova, SB, School of Business. She's an undergraduate there. I think the first Irish passport holder to be an undergrad at Nova SB. So she's got that claim to fame. And William and Sophia are 10 and 13, and they're at St. Julian's. So we're really happy to be here. And NHR Compassion was really as a result of a few phone calls to friends in the NHR community, and also UEFA and the Irish Business Network, who were supporters and in so very quickly, which I'm so grateful for. While we were locked down, you know, while the NHR community was locked down, we knew that this was going to be a very difficult time for Portugal, and we were hugely respectful of the fact that we are guests in this country. So we formed a foundation really to raise money through the NHR community, the business community who are NHRs, to support Isabel Joné at Banco Alimentar. And that's been quite a journey. I mean, Banco Alimentar is feeding 4% of the Portuguese population today. You know, something like just over 400,000 meals to people who are going hungry and children who are going hungry. And there is a new poor that has come out of the pandemic: physiotherapists, hairdressers, taxi drivers, people who've never been to a food bank. And the NHR community could not sit by and watch that. So we mobilized that community. Something like 12 nationalities came together. The entrepreneurs that I knew didn't turn me down, and certainly the Irish business community didn't turn me down. And we've raised meaningful money to support Isabel and the great work of Banco Alimentar.
Yeah, and it continues, of course.
It continues, Aoife, and yes, money continues to flow, I'm pleased to say, and we keep that going. And Jeff Graham, who obviously was moderating yesterday with Barry, was my co-founder of NHR Compassion, along with a great friend of ours, Tim Vieira, and Antonio Beja. And we cover all the costs. So every penny that comes through the foundation, 100% goes to Banco Alimentar. We're very pleased with the way it's working. And, you know, post-COVID, it may not be as relevant, but we will keep NHR Compassion there should there ever be a need for compassion in Portugal on this kind of scale. We'll be able to reactivate it. Hopefully we'll never need to, but we've started something that we intend to keep for the rest of our lives.
Great, thank you. Michael, it has been fascinating. I got to hand over and check with Arnold. Is there any further questions, Arnold?
Yeah, I mean, this is that was a very interesting talk. So thank you very much. Maybe just one last question. It's regarding the waste industry. Pedro is asking, is it an area where, you know, it would be good to invest, not as a startup? Pedro has a company well known in the local market, but just need a push to be transforming a multinational company, as he put it.
So let me understand the question. Is the question, is there an opportunity within a large established player to invest in a large established player that's exposed to waste solutions? Is that the question, or?
Yeah, no, I think that's it. Yeah.
The answer is yes. I mean, waste is a huge problem. I mean, one of the companies that we invested in, this company called Renewable, that's recycling denim, really opened our eyes to this, you know, this whole question of recycling. You know, 4,000 liters of water to produce a single pair of jeans. 87% of the fiber that goes into retail fashion, it goes to landfill or is incinerated. And that is about to stop by regulation. I mean, 2025, that game is over. Where does that go? I mean, this is a huge problem. Plastics, this waste area is absolutely in the sweet spot of tough to decarbonize sector. So you can play it along that chain, as I mentioned. You can be in very innovative companies, finding new ways to recycle plastic or denim. And frankly, I'm blown away by the innovation that I'm seeing in the sector. You can find innovator accelerators, companies like Renewable or Hoffman Green Cement, that you can kind of, these are quoted companies. They're relatively early stage, but they are listed. Or you can go into very established players who are continuing to innovate. But let's not forget, Renault, Peugeot, Volkswagen, they let Elon Musk get away with it. They weren't innovating at the pace of Elon, right? They're now trying to catch up. So I think you've got to balance, if you want to invest in waste as a thematic, you've got to balance your portfolio. You can be in an established player, but don't miss out on the incredible innovation that's coming through in the waste to value, as I call it, waste to value space in the next 10 years. It's going to be very, very significant.
And any other questions, Arnold?
No, that's it.
Perfect. Michael, thank you so much for your time. It's been fascinating, as always. I look forward to talking to you again at some other event in the near future. And I thank all of our members for attending the call this morning. And I hope that you'll join to hear what the rest of our members are doing in their smaller space later on this afternoon at the Member Meet Member event. Thank you for joining us, and good afternoon, or good day even.
Thank you, Aoife. It's been an absolute pleasure. I'll see you later this afternoon.
See you later. Bye-bye, Michael.